Welcome to the Advisory Group's Economic and Market Update and Year-End Proactive Tax Planning for 2024 workshop. Let's first start with some introductions. My name is William Glenn, and I am a Client Services Associate as one of the TAG team members. Also joining me today are Brent Beverly, the President of the Advisory Group, and Manny Chinche, a Senior Advisor at the Advisory Group. Both of them, along with the Advisory Group's Vice President, Chris Lee, are certified financial planner practitioners and wealth advisors at our Diamond Bar branch. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can help them make an informed decision. As a reminder, it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Our agenda is very straightforward. First, Manny will share with you a brief economic and market update. Then Brent will come up and share with you some proactive tax planning for 2024. Let's explore these points in more detail. To get into the meat of our presentation, I would like to bring up our next speaker, Mr. Chinche. Manny?
Thank you, Will. 2024 has brought some interesting dynamics for investors. Market volatility, political unrest, and fighting interest rate changes, more inflation, albeit at lower rates, and a contentious presidential election atmosphere. So how have equity markets performed? As this chart on your screen shows, year to date, the broad-based S&P 500 index has advanced and achieved multiple new all-time highs. While there are many factors that can continue to affect the movement of equity markets, some major equity market concerns we still need to monitor are the ones that we have already mentioned, which include the direction of inflation rates, further interest rate changes, recession concerns, geopolitical unrest, and of course the upcoming U.S. election. These items could be major factors in determining the future direction of the equity markets. As this graph shows, the inflation rate for August of 2024 in a one-year trailing period is 2.5%. This is way down from 2022 highs, but inflation remains an ongoing concern. After 11 interest rate increases over a very short period of time, with the federal funds rate rising from nearly 0% to over 5% and then pausing, at their September meeting, the Fed chose to reduce rates by 50 basis points, 0.5%. Their minutes reflect the fact that this may be the first of several interest rate cuts that we could see over the next year and a half. Although inflation has shown signs of slowing and interest rates have been reduced, Fed officials said in their policy statement that they were giving themselves time to assess how the economy was reacting to what has been a rapid campaign to slow demand and thus keep any rising inflation under control. Fed officials are watching key indicators to assess what they will need to do to continue reducing inflation, including labor statistics and the Consumer Price Index. Recession fears or a decrease in economic activity are always concerning. However, currently many analysts think that we're out of the woods for a recession. This is what many refer to as a soft landing. While others think we may still see a recession, currently anyway, that is not the case. The economy and job numbers are still relatively satisfactory, but that does not mean that the coast is clear. Regardless of if or when we could see that recession, the likelihood of it being severe is low. The global economy is still in a vulnerable position. Many issues, including the ongoing war between Russia and Ukraine and conflicts in the Middle East, coupled with trade concerns with China, are contributing to geopolitical unrest. Equity markets do not like the uncertainty that these conflicts bring. We will keep an eye on how geopolitical issues may affect the markets here in the US. Not to approach politics, but we do have to keep in mind, of course, that this is a presidential election year, and in 2025 we will in fact have a new president. As financial professionals, we try to provide proactive long-term planning for our clients. So while we don't have a crystal ball, historically speaking, the fourth quarter of the year is good for investors. This chart of 70 years includes several very difficult fourth quarters, including October of 1987, when the market collapsed and had its worst single day in history. When studying these 70 years of returns, however, 78.6% of the time, Q4 ended the respective year on a high note. And as we head towards the end of the year, we will keep a very watchful eye on equity markets. This reinforces our thought that when it comes to equities, we believe that long-term investing is a great strategy. Now here is a graph of the S&P 500 and how it has performed since 1980 through September 26th of this year, 2024. As you can see from this view, once again, those investors who focus on a long-term strategy were historically rewarded with significant returns, despite so many dips along the way. So while ups and downs are a part of the investment experience, the 40, 30, 20, and even 10-year investment timeframes have shown a healthy upward path. Here's a similar graph of the S&P 500, and once again it starts in 1980. As before, the point remains the same. Investors who focus on a long-term strategy were historically rewarded with significant returns despite all the various corrections and crashes along the way. So why are we showing you what looks to be the same graph yet again? Note in the heading of this graph where it says as of September 27th of 2022. The previous graph showed the results through September of this year, 2024. So why would we pick this particular date? September 27, 2022 was a low point of the market in 2022, which was a poor market year. As you can tell from our earlier graph, the market has done even better since this 2022 date. The S&P 500 has gone up for the most part since this 2022 chart. Even looking at that low point, you can see that the notion that those investors who focus on a long-term strategy were historically rewarded with significant returns continues to make sense. 2024 has already been an interesting year. We stand firm by our mantra of proceed with caution. Please remember, we will be watching all areas of the economy that we feel may affect our clients, and we're here for you in any concerns that you may have. And we would like to remind you of these 4 points that can help us approach your investments with discipline and focused direction. Your risk tolerance or appetite. By this we mean how much risk can you take, or better yet, how much can you afford to take? Your time horizon, or the amount of time you want to be invested in any situation, which can help you determine your entry and exit points. Your behavior. Market volatility is a part of the investing experience, so this can create anxiety and stress when volatility occurs. Do you know how well you can emotionally endure the potential ups and downs of your investments? And finally, your overall strategy. Are you looking at something that doesn't quite fit with your overall strategy? Perhaps the media is influencing you to make a rash or impulsive decision on your investments. We want your holdings to be congruent with said strategy. Panic can create more risk and potentially cause setbacks in your goals. So our main goal is to stay focused on that overall strategy. This might be an ideal time to remember these words of wisdom from the legendary Warren Buffett. Successful investing takes time, discipline, and patience. And here are some of the key items that we hope you take away from our equity market review. Caution is still the principal notion for investors. Inflation, while slowing down, continues to be a concern. Interest rates look like they will continue to fall. A recession is still a possibility. And long-term investing is a key strategy with equity markets. And as always, please keep in mind we are here to help you. Now let's phase into our next section on proactive year-end tax planning. To cover that section, allow me to bring up our next speaker, Mr. Beverly. Brent?
All right, thank you, Manny. As Manny noted, let's shift to proactive tax planning for 2024. Now, we believe that taking a proactive approach to your tax planning instead of a reactive approach can produce better results. Let's start by quickly distinguishing the difference between tax planning and tax preparation. Tax planning is looking ahead before year end, whereas tax preparation is filling out your tax forms after year end. Our strategy, as I noted, is to be proactive, not reactive. Now, everyone's situation is different, and therefore everyone's situation needs to be considered. Now, we find that taxpayers typically fall into one of three major categories of tax brackets. So the first brackets, the 10 and 12%, are the lower brackets. The next two, 22 and 24%, are the ones where investors really should begin thinking about calculating the tax impact on their decisions. And for those in the 32, 35, or 37% brackets, well, we call those tax sensitive because those are the highest brackets, and that's where you really want to be taking some actions to protect yourself. As financial professionals, we're always thinking about taxes and their impact, whether it's immediate, short term, or over the long term. Now, let me just add a note here. Tax savings by itself is not our goal. Our goal is to keep the most after you've paid your taxes. As stated earlier, for 2024, there are currently 7 income tax rates. So they're the 10 and 12% that we talked about, 22 and 24, and then the 30s, 32, 35, and 37. Now, under current law, this 7-rate structure, which was created by the Tax Cut and Jobs Act in 2017, is scheduled to automatically phase out on January 1st of 2026, only a year and a few months away. For 2024, though, the standard deduction amounts for those who do not itemize has slightly increased. These amounts are $14,600 for single individuals and married couples filing separately. That doubles to $29,200 for married couples filing jointly and surviving spouses, and then $21,000, miss that decimal point, $21,900 for heads of households. So how should you view itemized deductions if you do not take the standard deduction? Now, the old rule was primarily to accelerate or realize deductions and take them as quickly as you could. But the new rule with the higher standard deductions, the new rule now is to time or carefully plan those deductions. Typically, we want to bunch the deductions together to get over the standard deduction amount and get full use of your standard deductions, of your itemized deductions. In 2024, long-term capital gains still receive a substantial federal income tax break. Now, note for California, they do not. But for the federal purposes, you can tell here, it's pretty significant. There's still 3 tax rates. And the first tax rate on that is 0, up to some pretty good limits there. Then it goes to 15% and then to 20% for long-term capital gains. Now, these are for long-term capital gains, assets and investments that you've held for at least a year or more. Now, as part of a year-end tax planning strategy, it can be helpful for taxpayers to view tax gains and tax harvesting. So what do we mean by that? Harvesting capital gains is a strategy that has the taxpayer selling assets that are at a loss to offset capital gains. I think I said that wrong. Capital losses is a strategy for taxpayers settling assets that are at a loss to offset their capital gains. Now, this is a tax deferral strategy that could be valuable. The key fact to remember is that you can use up to $3,000 or $1,500 if you're married filing separately in capital losses above the capital gains against your ordinary income. Now, capital gains harvesting, capital gains this time, means taking the capital gains and paying taxes in the current tax year. So when taking long-term capital gains for tax purposes, though, the tax may be paid at a lower rate, but it may be paid sooner. For those who are not fully retired, remember to review your year-end retirement contribution planning. Make sure you've put in as much as cost-effective for you. Here are some 2024 contribution plan maximums that should be applicable if you're participating in one of these plans. Now, I'm not going to leave this up too long. If you're viewing this on the video, please pause the video so you can find the plan that you're a participant in and make sure you know what your limits are. Now, if you have questions about your specific plan, reach out to us. We're happy to help you. For some people with IRAs that have not yet been taxed, partial or full Roth IRA conversions can certainly be something to consider. Some benefits of a Roth conversion will include the strategy could lower your overall taxable income over the long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no RMDs. Currently it's set at age 73, later on it changes to 75, but with a Roth you don't have any RMDs. And then Roth IRAs allow tax-free withdrawals for beneficiaries, not just tax-deferred, but tax-free, because you're paying the tax on them ahead of time. So Roth conversions are not for everyone, but if you'd like to explore this, then please see us or your tax professional. Traditional IRA account owners have considerations to make before performing that Roth IRA conversion. Now, these primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, income limitations for future contributions to a Roth IRA, how it affects your other taxes. Now, in addition, if you're required to make a required minimum distribution, an RMD, for the year in which you do the conversion, you must be sure to take the RMD before you do the conversion to a Roth. Okay? You can't take your RMD and use that to convert to a Roth. You need to take your conversion and do it. Now, I realize all that's pretty complicated. I want to stress again, be sure to get professional advice from us, your tax advisor, tax professional. That's where you need to go. Now, as a result of the Secure Act passed just a couple of years ago, overall family tax bracket management, the family tax brackets, is a critical area for those untaxed retirement assets that you should explore each year. So one of your choices is always just to leave everything the way it currently is. But if you're in a higher marginal tax bracket than your beneficiaries, then just let them go and take it after your passing. But if your beneficiaries are in a higher marginal tax bracket than you are, it might make sense to take distributions in your tax bracket before you pass away and then convert these accounts to Roth IRAs or leave them, just after tax monies so that they've got more tax advantage to it. All right, if you're converting it to a Roth, then it passes to them tax-free, and they have typically a 10-year window for them to take that money out and let it continue to grow tax-free during that 10 years. An annual step to review this time of year is your marginal tax rate and your beneficiary's marginal tax rate each year to see what strategy works for you and your family. You may also consider college savings plans can bring tax efficiencies. So if you want to explore the tax efficiencies for college planning, 529 plans and so on, please do so. That whole college payment stuff has advantages that you may want to employ, whether for children or grandchildren or other related children. Let's talk about the annual gifting. You may gift up to $18,000 tax-free to each donee in 2024. Now, the way I like to say that is it's $18,000 per person per person. So this is a $1,000 increase from the $17,000 we had last year in 2023. Now, these annual exclusion gifts do not reduce your lifetime gift tax exemption, and the annual exclusion gift is doubled to $36,000 per tonee for a gift made by married couples. That's that $18,000 per person per person. So if you have two people gifting, that's double the amount. If you have two people receiving, that's again double the amount. So it just keeps growing. This is a good way to pass things on without having either estate tax or income tax to the beneficiary. Now, you can also help someone with medical or education expenses. Back to our educational deal there. You can do this without incurring gift taxes. We're going to talk more about gift taxes here in a minute. But there are opportunities to give unlimited tax-free gifts when you pay the provider of the services directly. The medical expense must meet the definition of deductible medical expenses. This is not complicated. It's a little tricky, but it's not complicated. Qualified education expenses are tuition, books, fees, and related expenses. Does not include room and board. Now, you can find detailed qualifications in the IRS publications. If you need help with that, please let us know. Now, remember I talked about the rates going up and things changing in 2026. Let me spend a little time on that now. All right. The Tax Cuts and Job Act, the TCJA. Okay, that's a big mouthful to say, so I'm going to use TCJA there, please. Tax Cuts and Jobs Act of 2017 was passed, and it brought many changes to the tax code. Unfortunately, unless any changes are signed into law, there are a few key tax rules that are set to expire on December 31st of 2025, changing the taxes back to where they were in 2017, starting January 1st of 2026. Now, here are some of the changes that are already scheduled. Income tax rates, individual income tax rates. If no action is taken before 2026, these new tax rates will expire at the end of 2025, and in 2026 we'll go back to the 2017 rates adjusted for inflation. Now, the tax rates we have today are lower and what we call wider. In other words, it takes you longer to get into the next bracket. In many cases, then, when this changes over, more income is taxed at higher rates compared to what we're going to have today. For planning purposes, given the same level of income, most people could find themselves paying more in taxes in 2026 than they are in 2024 or 2025. The salt cap will disappear. Now, this is not table salt. The TCJA eliminated or limited many of the previous laws governing itemized exemptions. And one of the examples is the state and local tax, SALT, SALT deduction, which is currently capped at $10,000 per year or $5,000 for a taxpayer filing separately. Now, this cap is set to dissolve after 2025. The child care, easy for me to say, tax credit will revert to $1,000 from its current level of about $2,000. The alternative minimum tax credit will revert. Now, you may have forgotten about alternative minimum tax. The TCJA made modifications that significantly reduced the number of taxpayers who fell into that alternative minimum tax, or AMT, level. And it made the tax filing process much simpler for many taxpayers. In fact, according to the Congressional Budget Office earlier this year, AMT impacts roughly 200,000 taxpayers annually. That's a pretty good sized number, but that number is estimated to increase to more than 7 million taxpayers upon expiration in 2026. Elevated tax exclusions, okay, for the estate tax. Now, as of now, barring any changes in 2026, the estate tax exclusion is due to revert to pre-2018 levels, adjusted for inflation, of course, expected to be approximately $6 to $7 million for individuals. That's almost half of what the current limits are. So let's dig into this in a little more detail. For those of you with larger estates, a wealth transfer planning item to think about is the exemption amounts for gift, estate, and generation skipping taxes. For 2024, it's at a high of $13.61 million, which translates to $27.22 million for a married couple. Any amount over that is subject to 40% tax rate, which is pretty high. Now, this high amount provides high net worth individuals a significant planning window to make gifts and set up irrevocable trusts and so on to try and avoid those taxes. As a reminder, as of now, in 2026, the estate tax exclusion will return to approximately $5.6 million, which adjusted for inflation is about $7 million. On November 26, 2019, the Treasury Department and the Internal Revenue Service, this is important, issued a final regulation, and they've got the code IR 2019-189, confirming that individuals who take advantage of the increased gift tax exclusion or portability accounts in effect from 2018 to 2025 will not be adversely impacted when this law change sunsets on January 1st of 2026. So there are opportunities to do something. So if you have a large estate, don't wait because the attorneys are going to be real busy. Get in touch with us. Now, a little side note here, you may have noticed the tax rate also goes up. Not only does the exemption go down, but the rate goes up from 40 to 45%. Just more and more and more. Charitable gift contributions, qualified charitable distributions, QCDs, are still a strategy for retirement savers. Now, as part of the Secure 2.0 Act, required minimum distributions, or RMDs, were changed to start at age 73 instead of age 72. Now, if you were born in age 1960 or later, your required beginning date for RMDs is moved to the year in which you turn age 75. So a little complicated there. But the QCDs, the qualified charitable distributions, are brought back to the original RMD age of age 70 and a half. So the tax law provisions allow retirement savers over age 70 and a half to directly distribute up to $105,000 from to their eligible treasuries from their IRAs, so straight out of your IRA accounts, and not pay tax on it. All right, it's a pretty sweet deal. One idea that experts suggest is that if you are charitably inclined, consider using all or part of your required minimum distribution, or RMD, for these qualified charitable distributions. Now, if you meet the qualifications to utilize this strategy, the funds must come out of the IRA and go directly to the approved charity for that year. Now, this will almost always save you more than taxes than if you tried to pay the taxes and then make a deductible charitable donation. Just believe me, the tax advantages work real well. So like many other strategies that we're discussing here today, this is one that needs to be done properly. So please see us, see your tax professional about this strategy and see how best to employ it for you. Now, we've talked a lot about the 2026 changes. Wanted to give you an idea of what that's going to look like. Now, the plan is we're going to stay with 7 brackets. They'll start at 10%, same, that looked pretty close. But now, instead of going to 37, they go to 39.6%. So let's see what changes that might make here. So for example, in 2026, a married couple filing jointly with $175,000 of income could go to a marginal bracket of 28%, from 22 to 28% on their tax rate. Another example is that a married couple filing jointly with $350,000 of taxable income would go from a marginal rate of 24% to a 33% bracket. Now, this happens with the way the law is written now. In other words, no new laws need to take place. No new action of Congress needs to take place. This sunset is already scheduled for December 31st of 2025, next year. So as you know, we enjoy keeping our clients aware of the tax law changes. So you're going to be hearing more about this as we get closer to 2026 so that you can do some planning and prepare. Because we believe in the proactive approach to your tax planning, not reactive. Let's get ahead of the game here. Now, a lot of professionals in taxes, investments, and especially estate planning attorneys are going to be super busy in 2025. So we recommend checking your situation in advance of the rush. Get there early. Otherwise, you'll be standing in line. The estate planning attorneys are likely to be working 24 hours a day and still behind. If you'd like to discuss how these sunsetting rules or any tax changes may affect your particular situation, please reach out to us. We'll be happy to assess your unique financial situation and get you on the right track. Now, to take us to the end of this presentation, please let me bring up Mr. Glenn again. Will?
Thank you, Brent. So, what can you expect from us at the advisory group? One of our main focuses is to review changes for our clients on an ongoing basis. You can expect regular communication and more frequent discussions. And you can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. In fact, we will almost definitely be offering other workshops that highlight tax changes and planning ideas. Please pause to read through these disclosures. If you want to reach out to us, here's our contact information. We will post this again at the end of this presentation. We are thankful for the opportunity to assist you with your financial needs. Remember, at our firm, clients come first. Your health and well-being is always our highest priority. If you have any questions or want additional information, here's information for you to reach us. We're glad to be of service. This concludes our presentation. Thank you again for watching. Have a wonderful holiday season.